Hello, everyone. Thank you for joining City National Rockdale's January 2024 Market Update. My name is Dara Roughley. I'm a Business Development Specialist here at City National Rockdale. And today I'm joined by our Chief Investment Officer, Tom Galvin, Managing Director, Senior Economist, and Senior Portfolio Manager, Paul Single, as well as Managing Director, Co-Director Fixed Income, Charles Luke. The views and estimates you will hear today are sourced from our investment committee's weekly meetings. During this call, our presenters will be sharing their perspective on what's in store for the economy and the markets in the quarters ahead, as well as implications for client portfolios. Just a few quick logistics before we get started. We welcome your questions, and we will all be on the line at the end of this presentation to answer them. So please type them into your console's Q&A window at any time throughout this session. Also, if you would like to download a copy of the presentation slides, you can do so in the resources window to the right of your console. And with that, I will turn this call over to Tom Galvin to get started.
Thank you, Dara, and hello, everyone. Thank you for joining us today. I just want to start out, in case you're not hearing me well, it's probably not your connection. I'm fighting some kind of a cold, so I want to apologize up front for it. So since our last webinar, we've made some changes to our forecast and our speedometer. So I wanted to quickly run through, make sure everyone's up to speed, our latest thinking there. As we saw today with the GDP print, the consumer is pretty resilient out there. And we see the outlook for the economy is more balanced. We only see a 50% risk of a recession and a mild one at that. We differ from consensus. We only see the Fed lowering rates 2 to 3 times this year, probably about the middle part of the year. We continue to think the U.S. is going to outperform other economies around the world, and despite some volatility that may emerge on a contentious election outcome, it really shouldn't impact the economy. The thing that continues to keep me up at night is the geopolitical world. There's a lot of crazy things out there, but you can't invest by that because the timing and the magnitude of things just really is not a knowable thing. On the right side, you can see some highlights there. So the market's had a big run since the October lows in both stocks and bonds, and has really discounted a lot of positive views as I see it. So if inflation were to unexpectedly tick up, for example, I think that's key to this market rally and the Fed cuts. So if inflation were to tick up, it could create some good buying opportunities for the volatility that won't unfold. For the full year, we're continuing to expect modestly positive returns across asset classes. In equities, we're continuing to focus on high quality stocks. On a regional basis, staying focused closer to home here in the U.S. Fixed income, maintaining our focus on quality bonds, and are looking to extend our duration opportunistically. As I said earlier, the improvements that we've seen in inflation, the resilient consumer, we have lowered several weeks ago our risks of a mild recession down to 50% and increased the soft landing probabilities to 50-50. So the risks of the economy are more balanced. We'll take deeper dives into the GDP report that came out today. It was very supportive of consumer spending, resiliency that we've been talking about, and whether there's a slowdown coming after the big spend is probably the key question. As it relates to our forecasts, only one change to highlight to you. We did, before the GDP report came out today, increase our GDP forecast for the year by 0.25%. So we're now at 1.25 in the middle of our base case. No changes to a corporate profit growth outlook, 6 to 12%, continuing to favor the lower end of our inflation forecast. We're only expecting 2 to 3 rate cuts in the Fed funds rate. And we do see greater stability in the Treasury markets this year. Also, our speedometers have improved over the last 4 to 6 months. They've been steadily shifting to the right, colors changing more positively. The most recent update really centered on the inflation outlook continuing to be better. So in the short term, there could be some questions, but we're looking at over the next 6 to 9 months with all these dial changes. And with the inflation outlook, that downward glide path continuing to look quite good. We did relatedly make changes because of lower inflation, better outlook for interest rates are going to drive improved credit demand. The business outlook should improve looking at over 6 to 9 months, housing and overall economic activity as well. Now, one slide we haven't talked about in quite a while is our political dial. So let's focus on that. We're in a big election cycle. So here in the U.S., we are expecting a very, very contentious election season, but we do not think it's going to have an impact on the economy this year. Also, it's really too soon in the campaign to know the specific platforms both parties are going to run on. So it's really hard at this point in time to draw definitive conclusions at this point about implications for the economy and financial markets over the next 4 to 5 years once the next election cycle is over. And policies could change. But given the substantial polarization that the nation has on the key issues, it's unlikely at this point that we believe that either party is going to achieve a sweeping mandate. So at this point in time, we're just assuming it's going to remain a split government, composition thereof to be determined. So the key questions as we see it are, will individual tax rates and small business incentives change? Some of them are expected to expire in 2025. Will Washington continue to keep fiscal spending as a preferred policy measure to keep the economy growing, or will some more fiscal restraint return and focus on the longer-term deficit issues? Approaches to trade, geopolitical relations can and will impact our standing in the world and global trade, so that's a very important one. One topic, though, we do think both sides of the aisle seem to agree on is industrial policy, if you will. The details are different, but whether it's Make America Great Again or Build Back Better, both parties are likely going to campaign and pursue policies to bring more investments and jobs back here to the U.S., especially in those strategically important industries such as semiconductors, software, research and development, defense, back here to the U.S. Now, while it's going to be a very contentious election season that could lead to some market volatility and could impact some sectors if some candidate pulls ahead and he's touting a change in policy, for example, history does show that over the long run, once elections are behind us, that stocks historically perform well, regardless of which party is in control. As this chart shows, of the 22 years that Democrats controlled all three branches of government, the annualized returns were 10.3%. In the 8 years, kind of in the center there, Republicans were in control, the returns were 14.5. Now, when government was split, the returns were pretty good. They were 11.5% or so if you exclude the minus 17% hit following the 9/11 attack. Now, not only do we have an important election here in the U.S., but we also have an important year of global elections. It's going to be one for the record books. I think there's about 80 elections or so occurring around the world, impacting half of the world's population and GDP. The outcome of these elections could, have a bearing on the geopolitical landscape and alliances among countries for a year to come. It could potentially impact this global shift that we've seen these last several years towards more polarization, more protectionism, shifting away from deglobalization, friendshoring. So the outcomes of these could be, very influential over the next several years. So we're keeping our eyes open there. Global trade, investments could also continue to shift in either the current path that we're on or maybe some other vectors unfold. But as we see it now, we're likely to see a continuation of the investments by companies in China into other areas, such as India, Mexico, other low-cost countries, and the potential leadership shifts that are occurring here in the U.S. and the EU could test the strength of the cross-Atlantic partnership if fiscal deficit spending becomes a higher priority and tariffs come along. So that's something we'll be keeping our eyes on. The other dial we haven't dived into for some time is the geopolitical dial. It continues to be the thing that keeps me up at night. Historically, exogenous events and shocks such as the Kuwait War, 9/11, the COVID pandemic, have been events that have ended expansions, triggered recessions, and meaningful market corrections. So this slide shows the most important situations on the right that would present a risk to the economy. In Taiwan, though the pro-independence party only has a narrow majority of the outcome, where they're in charge, will likely keep tensions high between China, Taiwan, and the U.S. But barring a low probable worst-case outcome, it shouldn't alter U.S. economic growth here. Neither should the Ukrainian conflict. Which seems likely to drag on for years and no end in sight. Sorry. The Israeli-Hamas war continues to drag on, and risks have risen. While the images of Houthis attacking supertankers from their 30-foot pleasure boats in and of itself don't stir meaningful concerns about war escalating, surprisingly assertive Iran sending missiles into other countries is a concern of a widening conflict. As you can see here, the Red Sea attacks have already had an impact on shipping costs. Due to higher inflation, due to higher insurance costs, a rerouting of vessels, which adds additional time and expenses, the shipping composite has gone up. While it's highly unlikely, as we see it, to increase anywhere near the pandemic-induced supply chain dynamics, if this rise is sustained, it could add upward inflationary pressures on goods, reversing the progress that we've seen in recent months. Sorry. The U.S. continues, as we see it, to have the best outlook for growth, as you see on the left side, because the aggressive fiscal and monetary responses to COVID and the structural advantages we have here in the U.S., the economy has strongly outperformed other developed markets. The other reason why we've had to stay positive on the U.S. and have emphasized it is our proprietary 4Ps framework. That's on the right side, and it's comprised of the 4 factors that we think will lead to countries gaining and sustaining a competitive advantage. It's policy, population, potential for innovation in industries of high intellectual property, and overall profitability. This scoring system is such as lower is better. Think of it as a golf score or a March Madness bracket where the top seed is the number 1. The U.S. by far, because the advantages we have on the potential for innovation in technology and healthcare and the good profitability that comes from that, has been foundational to our views that the U.S. is going to continue to be the preeminent developed market economy going forward. With that, let me pass the baton over to Paul to give you some more insights on the economy and the Fed. Paul?
Great. Thanks so much, Tom, and thank you all for joining us today. The U.S. economy is really in a sweet spot. What we have is inflationary pressures that have been dropping, and they dropped pretty significantly from the highs that we had in 2022. We have the Fed talking about lowering interest rates this year. They plan to cut the federal funds rate by 75 basis points from the present level. And we still have strong level of economic growth because labor growth continues to be in the positive side, and because consumers continue to spend and at a pretty good clip. We just got fourth quarter data out, and what we've seen is in the second half of this year is that GDP's consumption portion grew 3.1% in the third quarter and grew 2.8% in the fourth quarter, so roughly 3% for the second half of the year. The first half of the year was just about 2.25%. So you can see that the consumer is doing quite well. As a result, many people are thinking that we'll probably see a soft landing occur. This chart here is just the number of people that are going to Google and asking about what a soft landing exactly is. And hopefully things will play out this way. It is a good feeling story that would be terrific for the economy. But I just do want to put a little grounding on this, or a little bit of warning, is that, it wasn't too long ago that the expectations were for a recession. And you can see that that spiked in the summer of 2022 and continued to stay relatively high. So the outlook for the economy more than 6 months is very difficult to forecast. But what we've seen is an economy Well, people continue to get hired, they continue to spend money, and that's been the driving force all along. And fortunately for this economy, unlike past recessions, nothing's really broken. We don't have a bubble occurring like in the tech stocks, that caused the dot-com recession, or the housing crisis, or bad banking system. What we have is a relatively strong economy throughout the entire economy, and hopefully it will play out well. It does require the Fed to cut interest rates this year. And as Tom mentioned, that we expect that will happen in the second half of the year, mainly because inflationary pressures remain still on the high side relative to what the Fed would like to have happen. In terms of the labor market, it is moderating pretty significantly. The chart on the left is the change in non-farm payrolls on a monthly basis. That's what you see in the columns. And that does tend to be volatile on a monthly basis. So we're looking at the 6-month rolling average. That's the dark blue line. And you can see that sort of stabilizing at the same level it was at prior to the pandemic for those 5 years before that. But we are starting to see some cracks in the newspapers. We're often reading about some layoffs at many places. But what's interesting is the change in the dynamics of who's being hired versus who's not being hired. And you can see that in the chart on the right-hand side. This is measuring the percent change of the 13 major categories that the Bureau of Labor Statistics looks at. And it's interesting to see where the growth areas are and where the weakness is. The total, or the average, you can see is in the middle, the light blue at 1.7%. But the strong growth areas are in education and health services, leisure and hospitality. That's like people that work at restaurants or amusement parks, theaters, or whatever, and government. These generally are not cyclical sectors. These actually are sectors of the economy that have yet to fully recover the job losses that they had during the pandemic. So they're just playing catch up at this stage. The big growth engines of the economy, the ones that drive economic growth, the ones that create a great deal of income, those tend to be below the average. Now you can see that with professional and business services, financial services, that's us. Trade, transportation, utility, that's sort of an odd grouping. But manufacturing, that's a very cyclical sector. And you can see that the growth there is quite low. Information, which includes technology, is actually negative in the last year. So we're expecting to see a slowdown in income coming in from the job growth, but the job growth should continue to remain positive. But as I mentioned, the cyclical areas are not as strong as they used to be. And you can see that in the chart here on the left-hand side, and it's being driven by the consumer. The dark blue line is people's purchases of goods. The manufacturing sector is one way of looking at it. And you can see that that's not nearly as strong as services. And as with services, there's a lot more efficiencies. You don't need to hire as many people when you expand. But that's the area that continues to grow. And as a result, that's what's playing out in the labor growth. And you can see that on the right-hand side, where service labor growth continues to be stronger than what we have in the goods sector of the economy. But inflation is the key issue. On the left-hand side is the consumer price index on a year-over-year basis. And it did come down pretty significantly in 1 year, from June of 2022, when it was at 9.1%. It fell 6 full percentage points in a year, one of the fastest yearly declines that we've seen on record. But it's sort of stabilizing right now. And that is a bit of a concern for the Fed, because it's stabilizing at levels that are above what they want. The biggest force on that really has to deal with the fact that housing or shelter costs still remain high. This gray line here is the year-over-year change in shelter costs, and you can see up 6.2%. That's a strong, strong level. Now, to put in perspective how strong that is, if you take a look at CPI and take out shelter costs, you can see that the growth is 1.8%, the number that the Fed is looking for. So shelter is a big concern, and that's difficult for the Fed right now in terms of their ability to bring inflation down. On the right-hand side is other service costs. These are areas that tend to be linked to high levels of labor, and labor costs continue to remain high. The shaded area that you see here is what the labor costs are, and you can see on a year-over-year basis, 5.2%, much higher than it was before the pandemic, and that's really what the Fed would like it to come down to. And as a result, when the measurement goes into the CPI calculation, you can see it's at 3.9%, and it too is stabilizing. So this is the reason why we're not as aggressive in our view of the Fed cutting interest rates this year as the markets are. The markets continue to believe that it'll be happening, the high probability of it happening as early as March. We put the probability not happening until June and forward from that. But that's the big issue for the Fed. The dark blue line here is the federal funds rate over time since 2012. The light blue line is the neutral level. Anytime the dark blue is above that, that means the federal funds rate is restrictive to economic policy. When it's below that, it is supportive of economic policy. So clearly it's well above the level. And the Fed's plan is over the next few years to bring it back down towards the level that's, close to that neutral, that light blue level. But here the Fed is actually lucking out a little bit in terms of when they can cut interest rates. Because according to the Fed, the reason why inflation came down is not so much that they raised interest rates so much to quell spending, because again, consumer spending has been quite robust. But what it did was allow for expectations of inflation to drop. When the Fed started raising interest rates, the expectation that inflation 1 year out would be 5.4%. It now stands at 2.9%. It's moving in the direction the Fed wants. They think that's a very, very important tool. So the fact that consumers have not been overly influenced by the high level of Fed funds gives them a little bit of time. And that's pretty consistent with the general belief. I mean, a lot of households refinance debt, especially their mortgage. So they have plenty of cash. They don't need to borrow money as much as what we've seen in past cycles. Corporations, the same thing. They refinance debt. So the fact that the economy is not as sensitive to interest rates as what we've seen in past business cycles is a big, big boom for the Fed in terms of when they cut interest rates. It gives them a little extra time. But in terms of the expectation of when they will cut rates, the chart on the left-hand side, the bright blue is the current level of the Fed funds rate. That gray blue columns that you see there, those are lining up in terms of the Fed funds futures market's expectation of where rates will be at each one of the FOMC meetings this year. And you can see it moves down quite a bit to about 4% at the end of the year. The solid gray line that you see there, that's the Fed's expectation. We don't know when they will make the move. We just know what the year-end rate will be. So it's just a straight line. But the dark blue, you can see, we expect the Fed to keep rates stable for the first half of the year and then start cutting, as Tom mentioned, 2 to 3 times in the second half of the year. The Fed also has another tool for monetary policy, and that's their balance sheet. Over on the right-hand side, you can see the size of their balance sheet, how they had increased it significantly following the pandemic, and then they started to reduce the size of the balance sheet, which is restrictive to economic growth. Because really what happens is somebody has to buy the bonds that they're allowing to roll off, and that's just less reserves. But there's talk that they may start tapering that pace, and that will help stimulate the economy a little bit. This is an important issue, and Charles Luke will talk about it in a little bit more detail when he starts chatting. But the final slide here is bank lending. This is an important part of the economy. On the left-hand side, you can see the light blue line in 2022. Bank lending increased 12%. Last year, the dark blue, it increased, but mainly in the second half of the year. The first half of the year, it bounced around 0. And that's why an awful lot of economists thought we might go into a recession because there was just not enough bank lending. But the fact that it's starting to pick up is a very, very important issue in terms of further growth. On the right-hand side, it's the same sort of data, but it gives us a more contemporary view. The dark blue line is the year-over-year change. And then the columns are the 3-month change annualized, and you can see it's starting to tick up. So this should help out the economy going forward in terms of further growth. So what I'd like to do now is just turn it over to Charles. Charles?
Great. Thanks, Paul. It's good to see everybody. What I'd like to start with is really kind of take the ball from Paul, talk about the Fed balance sheet as just the first item to go through, because it has been getting a lot of attention with short-term funding markets and just what's been happening in overnight lending. Then I want to go through a quick view of fixed income credit quality, talk a little bit about our 10-year Treasury yield forecast, hit some specific areas on commercial real estate and emerging market debt, and then we'll talk about some of the technicals and supply and demand and fixed income. So the first thing that I wanted to talk about was what's happening with the balance sheet. So it was pretty clear from the December Federal Reserve meeting, as well as follow-on conversations from the FOMC, that they've started to heat up the discussion around tapering of the balance sheet. Now, the reason this is important is because those discussions were accompanied by volatility in the rates of short-term funding markets. And so you may have heard this referred to in the news as the repurchase agreement market. Going forward during the presentation, I'm going to refer to this as the repo market. But the reason this is interesting is because it last occurred in 2019, and that forced the Fed to step into the market and inject liquidity into repo. Now, the situation is very different today. It's nowhere near as volatile as it was in 2019, but we do expect the Fed to be keenly aware of the implications associated with continued reductions in the balance sheet, especially without time for the system to absorb that. And the other comment, and Paul talked a lot about this, the neutral rate versus Fed funds, is that based on where Fed funds is today, they may believe that's sufficient at this point based on the downward trajectory of inflation to control it at its current levels, and that diminishes the need for balance sheet reduction. So ultimately, what we're thinking, what we estimate, and it's a wide range of outcomes, but we think the tapering could begin at the end of Q1 in 2024, and the balance sheet reduction could stop completely by the end of this year. But I also want to shift a little bit more into the repo market and this concept of overnight funding, just to kind of break it down, because I know it has been making the rounds out there in the news. So with this slide, there are three things I want to focus on. If you look at the left-hand side, it's reserves in the banking system. So think of this as the shock absorber for the financial system. On the right-hand side, I have two more accounts. I have the reverse repurchase agreement program. The way to think about that is it's a tool for the Fed to control the Fed funds rate and to offer a buffer for anything they might be doing with the balance sheet. And then the last component to focus on is the Treasury General account. And the way to think about this account is it's what funds the US Treasury, essentially the working capital, and it's the account that facilitates the money flow between the Fed and the Treasury. So the first topic to focus on is the left-hand side. Reserves in the system are very ample today. So they're well above levels considered to be adequate. Most consider that to be around 2 trillion. We're at 3.5 trillion and climbing right now. And we're also significantly above the levels that we observed in 2019. The second thing to focus on is what's causing concern in the market is on the right-hand side. And that's that reducing the Fed balance sheet reduces the Treasury General account. And that requires the issuance of treasuries to refill it. And the source of that refill has been coming from the reverse repo facility. So in the dark blue on the right-hand side, you can see that that's drawn down pretty significantly. So the market is very concerned that further removal of liquidity is going to start to impact reserves on the left-hand side here directly. But we still think that's a long way off. But nonetheless, the interrelatedness of all of these facilities is really the key to the direction of the Fed's balance sheet. And so for these two slides, I just want to sum up the conversation in simple terms. Number one, the Fed is watching liquidity in the system very closely. This is likely going to cause a tapering of the balance sheet in Q1 and probably have an end to the reduction in Q4. Number two, reserves are healthy in the system. While we're seeing some small hiccups in the repo markets, it does appear the Fed is ahead of the issue and they are responding. Number three, rates may be restrictive enough in the Fed's eyes to stop reducing the balance sheet, and policy will remain restricted even if cuts happen this year. It'll be above that neutral rate. And number four, we think an end to balance sheet reduction will be a stabilizing factor on longer term rates, specifically the 10-year Treasury rate. So moving to the next topic, I wanted to center on the quality of the market in fixed income and what's happening with credit fundamentals and those trends. So let's start with corporate bonds. When you look at the left-hand side of this chart, we're focusing specifically on high yield, or what you may have heard us refer to as opportunistic income. And the specific measure that we're looking at here is interest coverage. So what interest coverage is, it's the amount of income available to companies to be able to pay the interest on their borrowings. And what you can see here as you move from left to right is that these levels are very healthy. So when compared to 2001, 2005, and now to 2023, you can see it's much higher than what we've had previously. And even more specifically, what jumps out to me on this chart is the single B space, which is sort of the second rung or starting to get into lower quality within the market, is at almost north of 4 times, which is pretty heavy for that part of the market. So when we think about high yield, the ability of issuers to service their debt, it still remains very high and resilient, and that gives us a lot of kind of tailwinds to being able to invest in that market. The second component is taking a look at the investment grade corporate market. So in this market, interest coverage is still very important, but generally it's very high. So what I wanted to focus on as an example was taking a look at profitability in these companies. So if you go back again here, 2007, 2015, 2023, you can see that the profitability measured by EBITDA margins has grown tremendously. And so we're still seeing companies that are performing successfully, making plenty of money to cover that debt service, and definitely moving in the right direction. So we're very confident in the taxable bond market from the credit fundamental standpoint, which definitely lays some groundwork to position portfolios. The next component that I want to talk about with credit quality is in municipal bonds, which many of you I know hold in your portfolios. So what we're showing here is that if we take a look at the left-hand side of the chart, this is the ratings changes from 2008 to 2023. So if you follow this chart from left to right, what you're seeing is the number of upgrades relative to the number of downgrades is much in favor of the number of upgrades. So that means that we're trending positively from a credit direction inside of the municipal bond market. The second thing to consider is what's on the right-hand side. So when we think about state funding and general obligation debt, rainy day and other reserve funds that are available remain very strong from a historical perspective. And if you take a look at the ratings across states, still extremely high, all A-rated or above, with 16 of those states coming in at AAA. And then if we think about revenue bonds and some other positions in the muni market, those balance sheets also remain healthy. And most of those issuer types have days cash on hand that exceeds pre-pandemic levels on a median basis. So we're in really good shape in the muni market alongside of the taxable market, just from a credit fundamental standpoint as well. So that lays the groundwork to talk about the next lever in fixed income for returns, which is the overall level and direction of interest rates. So when we look at the 10-year treasury, we do undertake a high level of monitoring and modeling for the direction of interest rates. So it's certainly not perfect, but what you're looking at is our 1-month forward predictions compared to the actual level of treasury yields going back to 2018. So what we're seeing with our modeling now is that we're projecting rates between about 3.8 and 4.3% going forward. And the current level right now is about a 4.10% level. So it's right in line with our expectations. And said a little bit differently, we believe that that 10-year treasury is in line, is fairly valued at these levels. So we continue to project rates having a decently high probability of staying above 4% this year, even with those Fed cuts on the horizon. So what that translates to in our positioning is that we want to take a market level of interest rate exposure relative to our indexes. So not more and not less. And second, we're suggesting that the fixed income target allocations in portfolios be fully deployed at the current level of interest rates. And so the next topic that I want to shift into are some just kind of idiosyncratic, esoteric things that we were really focused on last year across the board in the market. And that starts with commercial real estate. So what we're taking a look at here on the left-hand side is a measure of valuations in the commercial real estate market. So the takeaway from this chart is that valuations have become more attractive as measured through these cap rates. They've moved significantly higher. One of the areas they've moved higher in the biggest way has been in the office space. You can see that in the dark blue line. So valuations are getting more attractive in the market. And then if you look at the right-hand side, the percentage of loans that are actually going bad has slowed. So that peaked last year in the third quarter at about 10% on a monthly basis. Now it's down to 5%. So it's important to understand that we still are seeing loans go bad. And I know there are a lot of horror stories out there. So there is downside risk that does remain. But as we're seeing valuations adjust and the market become a little stronger just from an overall lack of defaults and a slower default rate, we think the market could stabilize a little bit in 2024. And the issuance in the market, the transaction activity has been very, very low. So we think there's the ability, if we get that stabilization, to see that market start to move at a little bit of a higher pace from a transaction basis. The reason that's important to us in fixed income is what's happening in commercial real estate will have a significant influence on mortgage-backed securities, and it's also going to affect broader rate markets. So one of the most attractive trades that was discussed last year were mortgage-backed securities. But if the commercial real estate market were to struggle, I think the outlook there is also going to struggle a little bit from a positioning standpoint. The second market that we wanted to talk about and give you an update on is what's happening in emerging market fixed income. So for many of you who've been with us for some time, you'll hear us talk about opportunistic income, and emerging market bonds are part of that opportunistic income allocation within a portfolio. So last year, and it's sort of continuing into this year, the outlook, especially what's coming out of China, is really starting to kind of impact and put almost a negative feeling into the emerging market sector. But there are a lot more emerging market names than just China to be looking at. And one of the things that's sticking out to us in particular is that when you compare emerging market bonds to US bonds, there's a yield advantage, if you look at the left-hand side of this chart now, of about 2.5%. which is pretty substantial, especially when you look at it over history. You can see the differential on the right-hand side. The other component that we're seeing start to happen is if the Fed does cut interest rates, that could kick off a global cycle of easing. So as the Fed opened up the playbook a little bit in December for what might happen forward with policy, now you're starting to see the domino effect with the ECB, the Bank of Canada, and others. So if we start to get that global easing cycle, traditionally that's a pretty good tailwind for emerging market bonds. But it's important to know that we haven't made any allocation changes yet, but we are expecting to see some attractive valuation points across 2024, which may make it pretty feasible for us to increase those allocations to emerging market bonds. And the last component that I wanted to talk about today is what's happening with the supply and demand fundamentals, because this is something that has also been in the news, especially relative to what's happening with Treasury supply. So what I wanted to do on this chart is take a look at the expectation for fixed income issuance, the number of bonds that are going to be in the market in 2024 for just the fixed income market excluding treasuries, and then looking at the treasury market in isolation. So what we're showing here is that if you look at the market without treasuries, the supply of bonds in 2024 is actually going to move down by about 33%. And so what this does is we have lower supply, but at higher interest rates, arguably more demand for fixed income than we've seen for the past 15 or 20 years. So those dynamics are very strong for investments in fixed income. It's one of the key elements of why we think we should be full weight in the fixed income market. The story is very different for the treasury market. We're seeing coupon issuance. And what I mean when I say that is any treasury issuance beyond 1 year, probably going up in 2024 by about 74%. So the fundamentals are exactly swapped in the treasury market relative to the broader fixed income market. You're going to have more supply. And we're also seeing the demand base for treasuries change and shift. So whereas we used to have a lot of foreign entities, and we still do, that number has been dwindling. And then direct ownership and participation in auctions has also been going down. Most of the liquidity over the past 3 years has gone to money managers, so they're expected to pick up a lot of the slack. And of course, with the stock and money market funds of about $5 trillion, there's a lot that can go in there. But those buyers are going to be more price sensitive. So they may be more attractive to what's happening in broader fixed income relative to the treasury market. So that could also cause some volatility in treasury rates. But ultimately, I think what happens there is our higher for longer forecast is intact and supported by those dynamics and fundamentals. So I'm going to stop there. I look forward to the questions. I'm going to pass it back to Tom on the equity side.
Thanks, Charles. So equities, let's dive in deeply there. So the 4 Ps framework are expectations for the U.S. economy to do better than other economies around the world. I touched on earlier. So this is, I guess, a proof of the pudding slide, if you will, of the advantages that the U.S. has had and how it's played out in terms of stock performance. As you can see on the left side, the U.S. stock market, as measured by the S&P 500, has meaningfully outperformed international stocks, whether it's developed stocks such as the MSCI EFR or emerging market stocks such as the MSCI EEM on both a 1 and a 5-year basis. Now, on the right side of this chart, what we show is taking the 5-year annualized basis, and if you had invested $100,000 5 years ago, it'd be worth, over 200,000, well over 200,000 in the S&P. It'd be worth much less, only 150,000 or so in EFA and only 120 in emerging markets. So this is a meaningful difference, and why we keep focusing on this, because many of our clients have their investments with other managers. Those other managers have probably had that invested in these non-U.S. markets, as you know, with the diversification as the reason. But our clients are better off with the emphasis we've had in the U.S. It'll help them achieve their goals faster. So the stock market's always got positives and negatives, a lot of forces going on that impact the earnings, that impact the multiples. So these are what we see as positives and the negatives for stocks this year. While the economic growth is expected to slow in 2024, it is still going to be growing due to the resiliency of the consumer. And after what is looking like flat EPS growth in 2023, EPS growth should resume in 2024. We're in about the 6 to 12% earnings growth range. Another positive that we show here on the left side is that history shows, as we showed earlier, that election results, regardless of the outcomes there, they tend to be positive. And if after a Fed pivot, if a recession is avoided, stocks do well. So there's lots of positives, and the broadening out in the participation in the markets has been a good thing. There are negatives, though, that we keep our eyes on, and why we're not, fully invested at this point. Global economies are slowing, and that could impact the earnings of multinational countries. And as we show on the bottom left side, margins are near all-time highs. And so if anything were to come along to challenge that margin expansion thesis that is out there right now, that could take the momentum out of the stock market. Now, keep in mind that since the market lows in October, the PE, the valuation multiple on the S&P, has gone from 17 to 20 times. So the way the math works is that for every 1% increase in the PE multiple, that reflects an earnings growth rate of around 6%. So you take that 3x multiple, it basically is translating into markets discounting something like an 18% earnings growth. So markets may be a little bit too optimistic at this point. So that I see as a risk, that a lot of the positives have been baked in. We also see high attractive valuations in the fixed income world that Charles just highlighted, and with investment grade bonds yielding well over 5% and likely to continue to yield over 5%. The competitive nature of fixed income is an issue for the stock market. So while we are looking to opportunistically increase our exposure to equities as we did in the fall, we are going to do this in a valuation disciplined manner. Some of the stats there in that matrix at the bottom are some of the things that we'll be keeping our eyes on when we look to make that. On this slide, on the left side, it shows that the market is expensive. It's in the red zone in terms of the S&P multiple being over 20. On the right side, we decomposed it. So the tech titans, as I like to call them, they're called the Magnificent Seven elsewhere. They are expensive. They're at 30 times. Without these tech titans, though, the multiple on the S&P is about 17. Not so bad. And where we're doing a lot of our homework on is in the smaller cap area, where the S&P 400 has a pretty attractive valuation level of 14 times. So we're doing some homework there. So valuations continue to be an important component for us. Another area that we're added to our list of key critical conditions is shown here. Financial conditions. This is a chart from the Fed. It uses 7 metrics: the Fed funds rate, 10-year Treasury, 30-year house mortgages, Zillow home prices, stock changes, BBB bond yields, and the dollar. So when the index is above the line, it means financial conditions are tightening, and it becomes a headwind to growth. When it's below the line, it becomes a tailwind. So focusing on the near term, in the pandemic of 2020, massive amounts of easing led to significant easing of financial conditions, the monetary steps that were taken, the fiscal steps, and that propelled strong economic activity. And with all the supply-demand imbalances that we had, it helped reignite in inflation. Then the Fed started its tightening program, one of the fastest tightening programs in history, and it's turned into a headwind for the economy. Now, recently, financial conditions have eased, interest rates have come down, stocks have gone up. So if these financial conditions continue to ease, if rates fall further, if credit market spreads continue to tighten, stock and housing prices continue to rise, the tailwinds to growth are going to drop below that line. And that could set the stage for a more visible multi-year economic expansion going forward that should help drive earnings for stocks. So that's an important aspect. One more on equities. Dividend stocks. After being the best performing asset class, bar none, in 2022, dividend stocks became the worst performing one in 2023, right? So we went from this green line up 20% versus S&P to minus 25% as a perfect storm occurred, including minimal exposure to technology stocks in the dividend index, higher interest rates. These stocks do poorly when interest rates go up, and poor stock selection in the strategies. Now, historically, the slide shows that when the Dow Jones Select Dividend Index lags the S&P by more than 10%, the subsequent two-year returns are very strong and pretty much recoup the large underperformance that happens. So this expected rebound in the asset class over the next several years, it's not going to happen right away, but over the next several years, it should. History is very supportive of this. And all the improvements that we've made within the strategy in our stock selection and our portfolio construction should support a rebound over the next 2 years. Last slide for me. This slide looks back over these last 2 years, and as we're putting this together, I found it very interesting because it shows the high volatility that we've seen across asset classes. It's been really significant over these last 2 years. Now we're all fresh, knowing the Nasdaq was up 45%. That's fresh in everyone's mind. But if you look over the last 2 years, what has the Nasdaq done? It's actually down 2%. Other equity asset classes, look at the 2-year average, barely up 1 to 4%. On the fixed income side, yeah, we've had a great rebound, but over the last 2 years, the high yield area that we've been favoring is like barely eked out a 1% return, while the aggregate bond has fallen 8%. So in theory, a 60-40 portfolio comprised of 60% of the S&P, 40% of the fixed income ag, would be down about 1.4%, all things being equal with fees and strategy the performance over these last 2 years. So when I was looking at the slide, a couple of thoughts came to mind. Firstly, is that while our capital preservation approach produced suboptimal returns in 2023 because of dividend stocks, if you look over the last 2 years, our approach has worked reasonably well. Secondly, this 2-year outlook supports our view that we had in 2022 that in the higher for longer thesis, that interest rates were going to stay higher for longer. That's going to lead to increased volatility and lower returns. Finally, after this 2 years of volatility and going back and forth, we might be coming near the end of this process. So if inflation continues this downward glide path, if consumers stay as resilient how they've been, if the mild recession gets avoided and geopolitical tensions moderate, the financial conditions easing could be setting the stage for a sustainable multi-year expansion and help clients get back on track to achieve their goals. So with that, let me fast forward and take it over to Dara for the questions.
Yeah, thank you so much, Tom. And thank you, Charles and Paul, for your insights as well. A quick reminder that if you do have a question, you can submit it in the Q&A console, but it does look like we already have a few, so we might as well get started. Tom, since you're here, we'll keep it with you first. You touched on this earlier in the session, but as we know, it's a very important topic. We are in an election year. We have a lot of clients who hesitate to make changes to their portfolios during election years, just especially as we get closer to November. How would you help advisors and their clients kind of overlook those fears with what we've seen?
Yeah, so the first thing I would do is make sure you're spending a lot of time talking to Dara, your portfolio manager, your trusted advisor out there, to make sure you've got your compass set for the longer term to the goals that you want to achieve. As that last slide that I show you, there's periods where there's underperformance, there's periods of outperformance, and keep your compass set to true north. And don't get too caught up in what's one of the aspects that's going to unfold as election season, comes, and all the polling data, and somebody's going to pull ahead and someone's going to pull behind, and it looks like this candidate's going to be ahead. So that means that he's going to shift in this direction, and then in energy, maybe we shift from an emphasis on renewables to more drilling in fracking here in the U.S., or maybe it means this or that. Don't do it, because you'll end up turning your portfolio around, because polling data is historically very unreliable. And if there's going to be significant shifts coming, it'll be a multi-year opportunity if individual taxes don't change, if there's industrial policy put in place, and you can see the visibility coming. That's the better way to invest, because the polarization that we have on all these big issues, I think is going to come down to the wire. It'll be a close race, and just keep your seatbelts fastened through it all.
Great, thank you, Tom. Paul, we've got a question over for you. With the terrorist attacks on ships in the Middle East that are causing ships to be diverted around Africa instead of the Suez Canal, causing an escalation in transportation costs, will this cause high inflation like what we saw during the pandemic? What are your thoughts on what we should keep an eye out for?
Yeah, that's a good question. The terrorist attacks have been happening either solely to container ships or predominantly container ships. They're not big on wanting to cause problems with some of their neighbors with oil tankers. But I think the number is around 500 ships have been forced to go around the Cape of Good Hope in Africa. That adds on another 2 weeks for delivery. So it is a big interruption and a bigger cost. The costs have quadrupled. But for the United States, fortunately, that's not much of an issue, because shipments from India and China tend to go across the Pacific and go to West Coast ports. Some go to East Coast ports and go through the Panama Canal. But actually, there's a problem, too, because of El Nino. The amount of shipping through the Panama Canal has been limited to about 50% because they just don't have enough water to push ships through fast enough. So it's not really impacting the United States, and really not impacting the price of oil at this stage. So it's not much of a problem for us. It is a bigger problem, of course, for Europe.
Thank you. Charles, we've got a few questions here in your realm. First one is, what are you seeing in terms of the maturity wall and its implications as we've seen another year go by here?
Sure. So let me define the maturity wall just real quickly for those of you who may not be familiar. But what's been happening with the amount of issuance we've seen in such a low interest rate environment before 2022 is that pretty much any corporation, any bond issuer has been able to issue bonds for a long amount of time at very, very low interest rates. And the majority of those rates are fixed. So when we talk about the maturity wall, what it means is, when are these issuers, when are these bonds going to have to be refinanced? And so when we look at the landscape right now, we really don't start to see a big spike in that refinancing until we get into mid-2025. So we talked a lot about this concept last year, that looking at 2024, there was still a lot of room for companies to maneuver. And by the time we get to a large increase in those refinancings in 2025, companies will have had time to really maneuver a lot and be able to be prepared for those higher rates. And then, as I showed in the presentation, you have profitability via EBITDA margins that have been increasing as well. So companies are pretty well positioned on the credit fundamental side, and they're not going to have to repay or refinance debt still for another 18 months in any meaningful way. So we still see that as kind of a tailwind to the market and something that's supporting bond prices right now.
Thank you, Charles. So Tom, we're going to loop back over. Is there a concern with the Chinese stock market declines that we've seen over really the last year and how it may broader impact the U.S. and the world's economies?
Yeah, so it's such a thank you for whoever posed that question. It's a really important one. I'm sorry, my system froze. It's a really important one. So for some time, we have been concerned about China. In our 4Ps framework, they have some strengths, but they also have many significant weaknesses. So we did have some exposure to China in emerging market Asia. We came out of that several years ago because we were very much concerned that the political direction that the country was going in was not helpful for the creation of revenues and profits for corporations. Its alignment with Russia in this trying to shift the new world order we don't like. And we also felt their response to COVID was such that the reopening that they had was going to be subdued, because after putting your population in basically confinement for over 2 years, you're going to lead to behavioral shifts. And so I think they're pushing on a string over there. Their economy is struggling. Consumers really don't want to spend. They built way too much on real estate, commercial, and residential. Charles and I, track the high yield markets over there, and they're still in trouble over there. Now, China's impact on our economies, not very high. We import some, goods from them. So what happens in China on an economic basis is less of an impact for us than it is on Europe, for example. Europe exports a lot into China. So part of the reason why we don't want to invest in Europe is if China's slowing down, the demand for Mercedes cars or Hermes handbags or other things that Europe does really well that the Chinese consumers have been wanting to buy, they're just not going to be doing that anymore. So if the economy, it should still grow, but I do think they're pushing on a string. The other, so I'm not overly worried for the impact on the U.S. economy. I'm also not overly worried on the impact of the financial system, because most of the Chinese debt is held locally, and so I'm just happy that we're staying cleared from it.
Sure. Thank you, Tom. We have time for probably one more question. So the recent Bitcoin ETF that we've been hearing a lot about in the news, what are our thoughts here?
Yeah. I was hoping you were going to ask that one. So the Bitcoin ETF, and I see there's a concern of valuation of the Mag 7 stock. So let me kind of put them together. So the simple answer on Bitcoin is no. For these many years, we have not liked cryptocurrencies. We do think blockchain technology has applications in certain areas, but Bitcoin really doesn't do anything. It's not a store of value. It's used in very nefarious ways. The companies that have been involved with it keep blowing up. And so just because the SEC decided to bless an ETF that is tied to it doesn't mean that there's an underlying value there. It's still a speculative area. It's proven it's not a good fungible currency alternative as many thought. Now there's a world view out there that thinks it is something, but as we see it, it's not an asset class that's investable. So I would stay away from it. The Mag 7 stock valuations, it's interesting. Many of them were super expensive at the start of the year of 2023, super expensive. And then the earnings, though, has grown into many of these companies. The demand for a select handful of companies that are well positioned for the semiconductor chips, for the manufacturing of those chips, and certain software companies that are front and center to take advantage of it. They've seen the benefits in their earnings. So while the valuations are high and they've discounted a lot, they're not overly excessive at this point in time unless something comes along to really not lower the revenue and earnings growth opportunities that they have. We like the stocks that we have that are taking advantage of AI. We're underweight the Magnificent Seven within our digital revolutionary theme, and we think that's the right approach going forward. Back to you, Dara.
Thank you all, yes, for joining us. We're just at the top of the hour here. Tom, Charles, and Paul, thank you as always for your insights. For those who are listening in, a brief survey will pop up shortly in your console. So please share your feedback and suggestions on future topics. A replay of this session will be available within 24 hours, and you'll receive an email letting you know how to access that. Thank you so much, and have a great day, everyone.